All right, first example here. This is a bond issuance at par. So at face value, there's no premium or discount. We're starting to see this in real examples. So Stark Inc. issues 10-year term bonds at par with a par value of $1.5 million, dated January 1st, year 5, and bearing interest at an annual rate of 10%, payable semi-annually on January 1st and July 1st. It records the following entry. So it tells us it's at par with a par value. There's no indication of anything that is premium or discount. Like I showed you before, you're receiving cash of $1.5 million. You're going to owe cash of $1.5 million. So that's a credit to a liability. This is, keep in mind, the journal entry at issuance, right? This is at issuance January 1st. We issued at January 1st. If it asks what's the journal entry at July 1st, well, that's a different story. We're going to deal with some interest. Okay, well, how does that interest calculation look? The journal entry to record the first semi-annual interest payment. So half the year has passed. And keep in mind, remember, we are dealing with some tricky dates. Well, the principal times 10% interest rate divided by 2, or times 0.5. Normally, you'd be doing $150,000 of interest per year. But because half the year has passed, or we're only using half the year, we are using half the interest at $75,000. What about the journal entry to accrue interest expense at December 31st, year 5? Now, keep in mind, here I'm going to draw a nice little diagram for you. Remember that interest expense is on the income statement. The income statement is a period of time, right? It's a report. So this is over time, right? This is interest expense throughout the year. It just goes up. However, interest payable, it's on the balance sheet. It's a point in time. So it accrues, we pay it down. It accrues, we pay it down. It accrues, we pay it down. You see that? Accrues, and then we pay it down. So the balance, and we pay it down when we pay the interest payments. However, interest expense is going to keep going up because this is interest expense, right? It's the expense throughout the year. So think of this like your credit card, right? This, each month you pay down your credit card, let's say in full. So this is your balance, right? It keeps going down. It accrues, you pay it down. Interest expense is the one that it's like your overall spending for the year. It's going to keep going up because you're constantly spending, right? Although maybe reduce it a little bit, save yourself some money, but don't forget to treat yourself. You deserve it. All right, so journal entry to accrue interest expense at December 31st, year 5. Well, why are we doing this entry? Let's look back. We pay it on January 1st and July 1st. So it's saying at December 31st. So yes, we'll pay it off the next day, but up until that point, we've been accruing it. So we've accrued it. We do the interest expense, right? Because it keeps going up. Interest payable, we have a liability of $75K, and once we pay it off the next day on January 1st, then this will go down to 0, right? We'll do this again. We will debit this, balance that out to 0. So far, just recapping, this has been without any premiums or discounts.